Hello guys, welcome to Progressive First YouTube channel once again. Like I promised you in the previous videos that I will be uploading useful contents that will assist you to improve your trading career. In this video I will show you some specific facts, and of course make sure you watch the video to the end in order to know the points I'm going to make in this video, so that you know when and how to use this particular strategy. So this strategy is what I call support and resistance strategy. So like I used to advise in all the videos, make sure that you exercise patience with Forex, because Forex is all about patience. Without patience, you cannot trade Forex successfully. So likewise, all these strategies in Forex works, but the point is, are you patient enough to wait for the setup to form in order to make proper use of it? So now, this strategy, I will be, we have like first and second version of the video, so that it will be easy to understand and of course short for you to view. The first version we focus on the chart and the setup, while the second version we included the indicators, because indicators also helps a lot in order to note exactly what you want. So but we first of all now look at the background of the chart. So here I used to like a white background screen because of these lines you see here, all these lines. So like I told you in the previous videos, make sure you watch them to also add more value to your trading skills. These lines are where the market closed for the previous day, opens for the previous day. In 4 hours chart, it means that where the market closed for the previous week, opens for the next week, closed for the previous week and opens for the next week. So but in 1 hour chart, it simply means, for instance, where the market closes for the previous day, open the next day, close for the previous day, and of course open the next day. So but why I usually use 1 hour chart for this, for my trading, but why I'm using 4 hours chart for this analysis is because the setup appeared in 4 hours chart. So as you can see, the same setup here at this point where the cross is, that is where it appeared when during the 1 hour chart analysis. But let's go back to 4 hours chart where the setup appeared now, so that we'll be able to understand how to use the strategy. So now, having said something about these lines and the reason why I like white background, you can go to settings and of course apply this white background. So what you need to do here is go to F key, then select for instance, you plus from here and select moving averages, but because I've already selected, let me just open them and of course show you exactly what to set there. So the first moving average is the 300 moving average. So you apply the period to 300, the shift to 0, method to linear weighted, then apply to weighted close. That is, and of course you select the color of your choice. Then okay, then you go to second, open this place again, and of course select moving average once again. Then in the second moving average, you apply the period to 100, shift to 0, method to linear weighted, and apply to previous indicators data. And of course select the color you wish. Then myself, I used to like parabolic, but I won't be teaching you about the parabolic. It's one of the indicators which I will include in the next video, in second version of this video. Then you go to open this plus, go to this place and select fractals. Here is it under Bill Williams. Then you select fractals, and because fractals help a lot to know when the setup is ready to move. So the third moving average is optional, not necessary, but I use it myself. So you can select the third moving average, set the period to 10, the method to exponential, and of course select the color of your choice. So let's go back to the chart. Now, how to use this setup is, when you look at in this place, for instance, the market crossed on the 26th of August, of course. But if I were you, throughout the day, because you know that every day has about 6 candles, but in 1 hour chart, for instance, you see there are numerous of candles that used to come out in the day. But in 4 hours chart, each day used to have 4 candlesticks. So after the first day of the that the market crossed above this 2 moving average and closed successfully, it's not just to touch it like you see in this place. So the market just touched the 2 moving averages, especially the 300, because sometimes it used to cross below, as you can see in this place. But the point is, be very, very careful to exercise patience and wait, in order to note whether it's going to close successfully below the 2 moving averages. Even if it is the first, which is the 300 moving linear weighted moving average, make sure that you wait to find out what is going to happen between these 2 spaces, that is the 300 and 100 moving averages. Because what happens is, why the candlestick closed the first day, allow it to close, the day to finish successfully, so that the next day you will join the trend and just trade what you see. Do not trade what you think the market is going to do. Join the trend as it's moving. Then in the following week, what you will do is wait for possible retracement, because sometimes it used to retrace, sometimes it doesn't. But what used to motivate entry point is, once on Monday you waited and the market did not close, it did not retrace, watch closely to see if it is going to develop this bullish engulfing candlestick or bearish engulfing candlestick in the case of a downtrend. Look at it, this very one. So this bullish engulfing candlestick used to, first of all, come down before moving up. So, and of course, this is the long one of it, this is the short one of it. But if I were you, this is what I will use to know if the market is continuing automatically without retracement, without retracing from the next week. You look at this place. The market made an attempt to retrace the previous day and the previous week. So, of course, it did not succeed because of this bullish engulfing candle that developed here. This is the major one here that triggered the automatic movement of the market to uptrend the following week. So once you see this on Friday, you should be mindful of what to do the following day, because possibly the market is not going to retrace. But for instance, the market retraced successfully or either closed above. So there is every tendency that is going to retrace before moving again. So what you do is, immediately you see this, join the trend from the next week. because it will continue moving like that. So now, I don't used to trade retracement. So what I used to do is, once the market developed this particular bearish engulfing candlestick, look at it here, look at this one. So indicating that the market is about to fall, and of course supported it with, pin bars, or what they call hammer man and all that. I used to opt out of the market, especially when it started ranging, especially these three powerful fractals that used to sometimes be in the same line. Sometimes one grows above, but two will be in the same line. Sometimes it will be in triangle form, like you see what is here. So you opt out of the market and wait for possible retracement. Go to another currency where it's the strategy formed and continue your trading. So if I wait and the market retraces to this place, look at this place. This candle that first of all touched the 300 moving average did not close above. It closed below it successfully. So the fear of possible market reversal is there. So you have to wait for this very candle to close. So long as this candle did not close successfully below the 100 moving average, expect another uptrend. I mean the market to reverse again to uptrend. So you have to wait for the market to behave finally in this place. Remember, there is no fractals yet. There is no pin bar yet. There is no bullish engulfing candle yet. So that is why you see some persons will enter the market so early, and of course end up crying at the end of the day. So before they will realize what will happen, you will see this kind of fake out. It will come and take the stop losses. So once you take out the stop losses, you'll be wondering what happened. Imagine it just took me out of the market and then come back to where I bought the market. So this is what really happens. So because like I told you, these two moving averages act like support and resistance at the same time. So you wait and see that the market have developed this bullish engulfing candlestick. And what it does is, sometimes it comes below, like in this candlestick, it comes below the 300 moving average and close above it to form pin bar or hammerman, or sometimes it comes below the 100 moving average and go back to develop pin bar or hammerman, as you can see in this place. But whichever way, so long as it will not develop bullish engulfing candlestick, do not buy. You wait until it develops this bullish engulfing candlestick. Once it develops, as you can see here, there is possible buy option. You first of all wait until it develops the second candlestick. Definitely that will be either pin bar or another bullish engulfing candlestick. That is how it behaves. So, or a possible kind of a bullish engulfing candlestick that can even go above this 100 and 300 moving average, and of course close above the two of them. So there are options that usually happen like that. So, but once it develops this second candle, then third candlestick will force this fractal to come out. Then you make your buy. Immediately this third candlestick comes out, make your buy from here or from wherever you meet it up. So wait for the market to boom, because definitely it will move radically. It will move, and of course pays well. So the next week, as you can see what happens here on Friday, you see this bullish engulfing candlestick here. That is what it used to close the market, and that is why the market did not retrace. The next week it continued moving, And that is why even when you find this bullish engulfing candlestick, it attempted to come below, but it can never come below in as much as this bullish engulfing candlestick have developed for the day. So that is why it moved for a while before retracing. So even if it retraces again, watch this place closely. The same thing happened here. You see this bullish engulfing candlestick pushed the market back, and that is why it went up again. So like that. But one significant you need to notice here is there are a lot of close range attempts between these moving averages, and that is indicating the possible market movement that is most likely to the market to form a downtrend. So, but in 1 hour chart, like I said, I use 1 hour chart, but I'm using this 4 hours chart to analyze the market, because that is where the signal comes, and of course where the signal is out, and of course that is, as you can see, my entry, and that is where I'm trading it, and of course choose to make the video now. So normally what I use is 1 hour time frame, because of course I used to make daily entries in the market. So that is why I use the 1 hour chart. So, but I will come to signify something with the 1 hour chart before I end the video. So, as you can see in this place, the market closed and closed successfully from the next week. And of course, you see, before the market closed for the previous week, there is nothing like bullish engulfing candlestick. Instead, it developed bearish engulfing candlestick. And that's why the market boomed down. So that is how it behaves. So in the next candlestick, of course, you join from here. Once it closed successfully, you join from here. And that is it will take you, of course, boom, down to this place. So once you see, like what I used to tell you, you see the retracement. So you look at the first candlestick of the following week was bearish engulfing candlestick. But if I were you, in this case, I will opt not to join the market for one reason: the M format, the W format, signifying a possible retracement. So that is what you see here. I waited for it to retrace. Of course, you look at this place, bearish engulfing candlestick. After 3 different candles tested the 3 moving averages, the 300 moving average, and did not close successfully above it. So the next was the bearish engulfing candlestick, and that is why you see this continuation of downtrend. The same thing happens here. You see the bearish engulfing candlestick forming. Reason why it happened like this is because the market, whenever it retraced a bit, it must form the M format or W format, as you can see in this place, for the market to continue the direction it wishes to go to. So that is why in the following week, it came up to retrace to this point, of course, to signify this M format before this market starts coming down, because for sure it is coming down. So I will show you the same thing in different charts before I end up the video. But in 1 hour chart, you can see what happens here. The very first day it crossed, look at it. It went up, retraced, went up again with the same thing like I told you. Bullish engulfing candlestick. None of these candles that touched the 2 moving averages closed successfully below it. And that's why the market went up. So like I said, I will show you different the same thing in different candlesticks. So look at here. Okay, GBP, JPY. See the same thing is playing out in this place. the 4 hours chart. Let's go to a different candlestick. Euro JPY. You see the same thing is playing out here. Let's go again to another chart. You see Swiss JPY. The same thing played out in this place. None of these candles have none of these candlesticks closed successfully above the 300 moving average. Likewise, in the previous ones I've been showing you, CAD JPY, the same thing is played out in this place after this candlestick tested the 300 moving average. Let's go to New Zealand dollars USD. You see the same thing is playing out in this place. Let's go to Euro USD. You see the same thing is playing out in this place. So be patient with this trading strategy, because that is the most important way to use it properly, and of course make the money in the market. So in the next video we show you how to use this indicator, and of course know when the market is about to reverse, either under the trend as you can see here, or at the top of these 2 moving averages. So there is some things I will share with you with this setup as you can see here. So in the next video, make sure that you like and of course subscribe to the YouTube channel in order to get the notification. See you in the next video, as I believe this is helpful.